All right, well, thank you all for joining us both in person here in Mankato and as well as the people that are joining us online. This is kind of two meetings in one. We have the in-person, but this is also our virtual meeting where we have people that are watching online today. So we'll do the best we can to kind of respect both audiences, and likely we'll get questions that'll come in to us from online, and you'll see that'll come around. It's kind of the same thing we've done for annual meetings and other purposes. You're just going to see it live, and then also make sure we take questions from here within the room. We got staff here today. A few people drove down from the Inver Grove Heights office just to observe this meeting, but Olivia Nelligan is part of the presentation, and she'll cover the financial reports in just a little bit. And then we've got some of the business leads for a bit of a panel discussion to talk a little bit about the businesses, and then be able to answer questions that you might have around the businesses and outlooks and so forth. We'll do our best. Let me just begin by saying that we are going to talk about forward-looking statements in the course of today, and some of those statements will turn out to be incorrect. And if anybody need to be reminded of that, consider yourself reminded. So we'll do that in the course in the course of the day. To begin with, I'd just like to introduce the board members and ask them to come forward and introduce themselves. And I think Scott, you might be kind of taking off the lead on this part of the portion, but invite all the board members to come up and be recognized for your travels.
I assume this one's on. Yep. Come on up, board members. Thank you, Jay. Good morning, everyone. It's great to see familiar faces. It's great to be back in person. So really appreciate it. On behalf of all the board, not just the folks that are here today, we want to welcome you. We thank you for taking time and come here. And with that, we're going to do some introductions, and then we got a few slides. So first off, I'm Scott Cordes, Region 1 Minnesota Director. I farm in Southeast Minnesota, corn and soybeans. Point of information, and I'll ask the other directors to do this as well. I also serve on the Audit and Risk Committee for the CHS Board.
Thanks, Scott. Dave Johnsrud from Starbuck, northwest of here. I've been on the board 9 years. I currently serve on the Capital Committee and the Government Relations.
Good morning, Dan Scher. So I'm chairman of the board. I farm in eastern Iowa. So if you go to the far east side, right next to the river, we raise corn and soybeans over there. We certainly welcome all of you. It's nice to see everybody's faces again and being in person. And you notice we have a lot of board members here, and that's purposeful. We try to get around to these meetings and try to listen to a wide variety of our owners. So we understand all of our owners, not just the area that we come and live in. So thank you for coming. Appreciate it.
Thanks, Dan. My name is Tracy Jones, Region 5 Director from Northern Illinois, and I serve on the Capital Committee, and I'm Chairman of the Governance Committee. So I farm corn, soybeans, a little bit of wheat, and still have a livestock operation, low cattle.
My name is Dave Kaiser. I'm from Mitchell, South Dakota. And I have my wife and sons have a grain and cattle operation there. I currently serve as chair of the foundation and on governance committee.
Good morning, everyone. I'm Alan Holm from Sleepy Eye, Minnesota. I farm there with my son-in-law, and I currently am the chairman of the Government Relations Committee, and also serve on the Corporate Risk Committee, which I was formerly chairman of that for about 3 years.
Good morning. I am Hal Clemenson from northeastern South Dakota. I live in Aberdeen. My farm's in a little town, Condi, South Dakota, which is kind of between Aberdeen and Watertown as the crow flies. We raise corn and soybeans there. Raised a couple daughters that both moved to Minnesota, by the way. I can't get them to come back, but anyway, that's another story. I am on the Corporate Risk and Government Relations Committee.
Thank you, Hal. Perry Meyer, farm north of New Ulm, about 25 miles west of here.
serve on the Risk Committee and also chair the Audit Committee. So I also want to welcome and thank you for coming today.
I'll let you guys sit down. Al and Dave don't go too far. And Perry, it's great you're here. For those you don't know, he had eye surgery last week, so we didn't know if he's going to make it. He's looking really good. So we've got a couple slides to go over. I'm going to have Al and Dave go over around some proposed amendments to bylaws. We'll talk about equity a bit, but just a couple things before we get started. One is our purpose, creating connections to empower agriculture. So let that sink in a little bit as we have our discussions this morning, as we move forward. You know, CHS for about 90 years has been working with local co-ops, helping farmers and ranchers to grow the food that feeds the world. So just kind of use that as a level set. The other thing I would like to bring up a little bit to think about is our cooperative governance. That allows us to be in this setting today, and you might think that's kind of obvious. But look at it this way. If we were a public or a private company, I don't think you would have this opportunity to visit with directors. The CFO, the CEO, senior staff, they're all in the room, and you have a chance to interact with them. And I would encourage you to take the information in, ask questions, but most importantly, give us feedback. That's how we create a strong cooperative system. So we need that interaction, that 360 feedback. Please don't be bashful, and I'm sure you won't. I was in Madison last Monday. They were not bashful. Bismarck had some other discussions on Friday. They weren't bashful either. So from there, I'm going to turn it over to Al to talk about some amendments.
Thank you, Scott. Good morning, everyone. And again, welcome for attending here today. So this morning, I'm going to cover a couple of slides here that are going to be on your screen behind us here. They're going to be about updates to the CHS articles and bylaws. At this year's annual meeting, the delegates will be asked to vote on these proposed amendments, to the CHS articles and bylaws at the 2021 CHS annual meeting. These changes were planned to be communicated last year, but being with the pandemic and the virtual annual meeting last year, the board decided to push them off a year and bring them so we could actually work on these in person with you. So, we've been discussing these at owners' regional meetings. We've been discussing them here at owners' forums like we are here today. And also there's going to be, some information on your CHF websites if you want to go there and look at it. And then there'll be some CHS emails coming out to all of you, our owners, about what this entails. So basically, the recommended amendments would clean up obsolete language that are in the Articles of Incorporation. It would confirm the current practice of allowing electronic and mail-in voting. So these proposed amendments would clarify these voting options for annual meetings, special meetings, and then the CHS Board of Directors, which a bunch of us are here today, we recommend bringing these to a vote and an update. So basically, we want to update and go to a vote at the CHS 2021 annual meeting in December, and the board does recommend these changes. So now we're on slide number 2. So basically, just a little bit of information about what's gonna happen here, what we're trying to change. So basically, some of the examples of some of the language that are going to be basically removed is Cenex Supply Marketing, Cenex Incorporated, defined members, defined business units, defined member board, equity participation units. So basically, these are just straightforward changes that basically streamline, the words in our amendments, and you can find all these details on the website, or we have it here today in print if you'd like it. So basically what we want here is to get some of this stuff removed, clean up some of this language, and then move forward with this amendment. So if you have any questions, you can ask any of us board members here today. You can talk to us at break time or lunch or ask questions now. So again, basically it's just a cleanup of some language in the bylaws, and then we can get our bylaws up to date. Any questions or concerns? Like I said, you can, if you have questions, email any of us or give us a call. or like I said, at break or lunchtime, feel free to ask us if anything comes up at that time.
Okay, I think we'll turn it over to Dave to talk about equity. So if you think of a question, we'll have time to answer it. So, thanks, Al.
Thanks, Scott. Since January 2021, the CHS board authorized an additional $50 million of equity to be redeemed. $25 million of that $50 million will be going to the local cooperatives, paying the oldest equity first. And I believe we're near within the year 2007 now. The other $25 million will go out to the individual owners as they are requested for 70-year-olds and estates. Given the fact that we also sent out $33 million of equity before the annual meeting, or we authorized it before the annual meeting and sent out shortly after the annual meeting, we will have sent out $83 million in equity for fiscal year 2020. Also sent out $30 million of patronage, for a total of $113 million having been sent back to the country in this past year. Given the pandemic and the challenges to the business for that period of time, and now seeing light at the end of the tunnel, plus a good spring season, we were allowed, our revenues and earnings allowed us to return this extra $50 million. So we thank you for the patronage. Any questions that I could answer in this regard? John.
Don't think that matches up with the current equity pool.
Okay, does everyone hear John's question? He's inquiring as to why it's not a 70-30 split as the patronage pool would reflect that we currently are at. The reality is, John, over time, it has been a 70-30 split. If you go back to the beginning of CHS, it was. In some years, it was beyond 70-30. As of late, you're right, it has not been. And we kind of shifted the focus to more cash available at this time and making sure that we have plenty of cash to take care of CHS and that we have a strong balance sheet and we have capital available. And you're right, that's the way and it doesn't look right. But the other part of it is we're looking at two different patronage types of payment. The individual co-ops are paid by the year. So as I said earlier, we're up to 2007. And the individuals are paid off as they become 70 or there are estates to be paid. And there's two different programs. Do we intend to continue doing this? I can't say. That's a board decision each year. And it's going to depend upon somewhat of the earnings we have. But you're right, and it's not being overlooked. Please understand.
Other questions? Well, if you think of one later, we'll still be around to answer questions. I'm going to turn it back to Jay. And once again, thanks for being here and being engaged. One thing I do want to bring up is for those in Minnesota, whether managers or directors, at the end of the month, there is the association director meetings. Thief River Falls is on Tuesday, August 24th. Morris is on the 25th, and New Ulm on the 26th. So there'll be another opportunity for the Director Association of Meetings in Minnesota to have questions as well. Okay,
Good.
Jay.
Thank you, everyone. Thanks for all the directors being here. You will note in the course of the day, we will try to repeat your questions only so the people online can understand the question. If we're doing our job, we will do that. So thank you for doing that, David, and for John's question. So in the course of today, I'll give just a little bit of an update on how the businesses are doing, what we're seeing right now, what we're working on as a company, and a bit of report to you on what we're working on as a company. Then Olivia Nelligan, after a break, will come up and give a financial review of our third quarter and then year to date. And then we will finish up with the business panel after that. So let me just begin by saying it's just great to be back with all of you and in person. we've done what we've had to do with annual meeting and other things, and the board didn't like it. None of us liked it, but we did what we kind of had to do in that window. And frankly, I said 2 weeks ago, I think we're late in the fourth quarter of this game. I still want to say we're late in the fourth quarter of this game, but we'll just have to see how things kind of pan out going forward. But we do, we held all 5 of these meetings in person. This one is virtual as well for those that wanted to partake that way. Our intent is to have the annual meeting in person and invite everybody to attend. We'll deal with the facts as they present themselves when it comes to it, but right now the intent is to be in person for an annual meeting. And these events just are really, really important to me, to the team. I know they are to the board. And as Scott pointed out, this is a point of difference, that we can have this kind of interaction. Sometimes we might not agree. That's okay. That's okay. The point is that you can talk with each other in a forthright way. And maybe through that dialogue and sometimes a disagreement, maybe we'll end up with a better decision than we otherwise would. That's okay. And I just think that's part of our history, but at CHS, it's part of the fabric of the company, and it's important to me to be with you. So 3 priorities we're working on this year in 2021. 3 priorities. One was the safety of the people. Second was our financial health. Third is making the company a better place. First point, just around the safety of the people. Like I said, I thought, frankly, standing here today is different than our very first one of these, where, we weren't seeing some things kind of bubble back up a little bit. But we've had an approach of doing what we needed to do during that window. At CHS, 80% of our people never left the workplace, never went anywhere because of the nature of our work and where they were located. So we were a bit of a unique company for the size, because all our people really never left for the most part. And those that had, we're working with that and are on the road to coming back in person. And, I think the world is just going to be a little bit of a different place in terms of that return to work. And I think as a company, we will largely be back in person. We will have a segment of people that are both remote and in the office. But we had that program before the pandemic. We always have offered that. And then I think we might have a very small sliver that is remote. And I think my own view is, I think over time that, we could see a further evolution of that. I think as leaders at companies see that and say, okay, I thought this was going to work okay, but maybe we need to make some changes. And I think employees are going to say, I thought this was going to work okay, but I'd like to propose some changes. Particularly, when everybody in an office is remote, that's one set of circumstances. But when some are in and some are remote, I think that's just going to be a new dynamic that we're going to work through. But offices, in the Twin Cities and other large cities are just, we're learning as we go. And we're going to have a starting point. We do have a starting point, but we also acknowledge that likely we'll have some evolution to that as time goes on. The board's back meeting in person. I'm in the office. The team's in the office. So we're gearing right back up. Second priority this year: protecting our financial health. So let me bring you back to 12 months ago, about right now. So we'd be talking August of last year, right at the doorstep of a new fiscal year. At a time we were losing $30 million a month, not a year, $30 million a month in our energy platform. Ag was still suffering with low commodity prices. I know we think about $6 corn today, but it wasn't but a year ago, and there was a 3 in front of that number in many areas. And that was the circumstances we had, with no vaccine on the horizon, no end to this pandemic on the horizon, and we're looking at a really, really tough year staring us in the face, because we open up September 1. The decisions that we made as a team was, we are not going to wait until we see how the year unfolds to make changes. Because if that's the case, then we will have suffered all the pain. Then we still have to make the changes, and they take some time to be impactful. So a year ago right now, we launched an initiative to take $100 million of cost out of this company. That's on top of the year before, we took $50 million of cost out of this company. So that 100 that we took out this year, about half of it came from our employees, either in wage freezes or cutting headcount. And about half of it came, we just cut expenses. So that was kind of step one. Step two is we're going to do a better job, and Olivia will speak to this, of how we use cash at the company. So of the existing cash, how can we use it more efficiently, effectively, get more velocity out of it, just to do a better job with the cash that we have. So that was a second big initiative. A third one was, as David pointed out, is our decisions around equity. Again, a year ago at this time, what kind of year do we have coming at us? Our recommendation, to the board of directors was be light on equity distribution at that moment in time, and then take it up as the year unfolds when we see what kind of year we have. That was it in a nutshell. So were we satisfied as a group? And I'm speaking for management, and the board can speak for themselves, but I think I am in that. No, we weren't. But if people are disappointed about that distribution of equity decision that was made back then, you really should give your disappointment to me. Because it was my recommendation in which to propose that. And it was centered on those kinds of facts of the year is looked really, really unsure for us as we began it. And we just said, let's look at this as it unfolds through the course of the year. I support what the board decided. I think it was the right decision, and it allowed us to look again as the year did unfold and make a subsequent distribution that the board just announced. And that all falls within living within our means. It all falls within that. And I know it's kind of a quaint sounding thing today of you live within your means. We don't think it's that quaint. I mean, we think it's the way we should run the place. And sometimes that makes decisions that cause equity, splits not to be maybe what they would be hoped for. That can be, but it is centered on the fact that the cash is what you have, and you can use that in three purposes. One, investing in the business and growing it. Second is the cash to run the place, and third is cash back to the people who own us. And we have to make a decision around all three of those aspects with the sources that we have in front of us. Now, as we've come through the year, we're really seeing the company in just increasingly better shape. And Olivia will speak a little bit to that. But the energy platform, just month by month, is getting into a better role. Now, keep in mind, they started from losing $30 million a month. So we had a road to go to get out from underneath that. But each month, much better performance. Our ag side of the business, frankly, is carrying the company this year. The benefit of diversification, but the ag side of our business is really, really having a strong year. And you'll hear, I think, from the panel that that outlook looks strong going forward. Always some issues out there, and we're kind of built to be a little paranoid about things that can happen. But we really feel that the year going forward also provides some nice opportunity. Then the third priority is, frankly, run the place better. And look for ways that we can make this a better company. And that's not centered on the pandemic. That's not centered on anything like that. It is centered on the fact that as we look forward in our industries, we fundamentally think that this business will stay tough, that the impacts of competition just will do nothing but get tighter and tighter. And we cannot find ourselves in a situation where we just hope that margins get better. Maybe next year will be better. Maybe next quarter will be better. Maybe next month will be better. Well, maybe they will. Maybe they will. But we are really, really focused on operating better as a company so that if they don't, we can still be successful. We can still have cash to invest in our business, to run the place, and to return to you, even if margins stay tight. Now, better years are more fun. We get that. But we also know in the businesses that we in, at least in my 37 years, there's more years where it's tough battle every damn day than there are where the wind is at your back and it's kind of easy. Most times it's tough every day. And I don't know why we sign up for this line of work, but we do. And we do it every day and every year. And for some of us, we couldn't think of a life any different way. I mean, if I'm not careful, after 37 years, I'll make a career of this. But I think the aspect of operating the business that way is just healthy for us. So what does that mean? Run the place better. So let me give you just a couple of examples of efforts we're doing, because the cost cutting, we can't run that play forever. We just can't run that play forever. We need to invest in the business. We need to invest in our people. We needed to take this step this year because of something called a pandemic, but that's not the way we can run the company for here on out. We need to find ways that we can invest where we need to, and to do that means we've got to take cost out in a different kind of way, or raise earnings in a different kind of way than just, well, let's just raise our prices. We got to find different ways to create that margin pool to increase. So, examples. I'll lead with an example in our grain platform that some in this room may kind of have some insight into, but some may not. And I think anybody that does or doesn't say, well, haven't you been doing that all along? The answer is no, we haven't been doing it all along. And the case in point is many times, even within our own company, we would make decisions that were good for a location or a division that ignored the impact across the company. And that stuff is done. It is done. If we make decisions that are good for a location, that means it is good for the company because we have got the right people around a table to look at it. So, case in point would be we have had many times where other grain companies would come into one of our own retail locations and bid over CHS for the grain that day. And that location, for their P&L, was a good decision. Made good money, better money than they would if they sold it to CHS. Good for that farmer group around them. What's the problem? Frankly, we operated the company that way for a long, long time. Well, the problem is this. At that same moment in time, when we might have sold to, you can pick the company's name, John Griffith might have had a ship-in berth waiting to load. He may have had trains on the track waiting to load, and one location sold it to somebody else, and that whole thing kind of collapsed. When I say it collapsed, that means it cost us. Now, somebody made a dime a bushel more somewhere, or a nickel a bushel more, but the impact on the company was a lot more than that. But nobody had any visibility to it. Nobody saw that. So, in fairness to a location, nobody told us. Well, that's what I mean by that stuff is done. We're going to make sure people are around a table, the right people around a table, so that if we do sell outside CHS or buy outside CHS, it's for the right reason. And there'll be times when it is the right reason. We don't have a ship in berth. We don't have trains sitting on tracks. And if somebody's willing to offer a dime over, maybe we should sell. But that's just a whole different way of decision making. Now, I'd also have to say right now that's awful manual. We got to actually physically get people around a table, and that's not the way we can scale that. So we're investing in technology to help us be able to do that in a more efficient way, because that isn't the flavor of the day or the things that we need to do because of a pandemic or anything like that. This is the way we want to run the firm going forward. And because it isn't in the category of, well, let's just cut the travel expense again, or let's just raise prices and maybe we can get that through. This is how do we run the place better and make more money and have higher performance with what we have, which is hard work. A lot of change in there. A lot of people did business one way. And really, nobody said it wasn't right. And I just, so I'm not critical about the past. I'm not critical about anyone. What we are saying is in the future, we're going to do it differently. And in the future, we think we can perform at a better level. And you can extend that same example to agronomy and how we source that, and the fact that Gary Halverson heads up both our wholesale and our retail arms, so we have the right eyes on decisions that are being made with both of those platforms. And also in our energy area. So I use one area as an example, but this point gets further spread across the company. In Minnesota, we have a canola plant up in Hallock, Minnesota. You know what? CHS at one time, Rick probably had 3 bids for canola up there. Our own retail location, a grain marketing bid, and the processing bid for the same bushel of canola. Not anymore. There's 1 bid. And the right people around the table will decide if it goes for an export market, if it goes for another market, or if it goes to our own plant. And those are kind of examples of how we are attempting to raise our game. Now, we got a long ways to go in some areas. We got a long ways to go. We got a lot of change management to be made. We have systems to develop, but it is all in this aspect of running the company better and not relying on the things we needed to do that got us here around some cost cutting and things like that. So just big work. That's why we called it up as one of our 3 priorities. Let me just transition a little bit though and relate that to the strategies of the company. We only have 4. And one of the reasons we have 4 is because we think 4 kind of covers what we need to do. 1 is making sure we're taking steps to be the preferred supplier and to people that own us and to customers around the world. 2nd is to evolve our business, to grow our business, and to transform the company. The side of growing our business is one that I think, frankly, everybody is now kind of back at the table leaning into. We had to get through this pandemic. We had to get through a year that was really going to be challenging, but investments into a Fairmont plant, and I get some of the issues that come with that situation. We also just announced from the July board meeting of $70 million into the Mankato facilities to increase our production of soybean oil. And I'll talk a little bit about why and what's going on in that space. And I think John will a little bit later, John and Darren will a little bit later too. Another $70 million into Myrtle Grove to increase our ability to export product. About 5 years or so ago, John, we made the investment into the Pacific Northwest and our Tempco facility for $250 million to increase our capacity to export product off the P&W. First 4 years of that didn't perform at all. The investment was a non-performing investment for the first 4 years. This year, it blew the doors off. And that's the way some of our investments go. We don't know what the conditions are going to be. Nobody knew that the tariffs were going to come up the way they came up and shut off the P&W. But boy, this last year has been amazing. What's gone through that facility, which is one of the reasons why we got to live within our means, keep the balance sheet strong, because we don't know how those investments all play out in time. And then in our energy platform, and Darren will speak to investments that we're making around the brand, but we're still putting $300 to $400 million a year into that business. We're doing it differently than we have been doing it. It's not around to make ourselves bigger. It's not to buy more refineries. It is to make ourselves better. Making sure that we're competitive with anybody else out there. And investments are just tuned to doing that as opposed to, well, let's just make more. Because frankly, in the energy space, there's a lot of things coming at us. Well, really in all the spaces that CHS operates in, there's a lot of things coming at us. And I'll speak to that as I close up. But I do think that the point that I would make is We are investing in the business. We are, and I can get that, well, maybe you could give that money for equity retirement. We got to make decisions on how much gets put in each of those three buckets. But we are investing in the business. We will continue to invest in the business. One of the biggest aspects that I say is kind of giving us an opportunity, particularly in the strategies that we have, is what's going on in the renewable diesel industry. And Merlin and his board and I talked just a little bit about that during coffee. It's a story that hasn't made the front pages yet, and it's coming. It's coming. The amount of what today is soybean oil that was targeted for the food industry is now targeted to really the state of California and to go into a gallon of diesel fuel. And not that many people, I say, have really visibility into what's developing in this space. And the amount of soybean oil that was targeted really only for the food industry is now going to the energy industry. So we all recall when ethanol had that window of food versus fuel, remember that? There was a brief window where that was a topic. It kind of went away when the markets kind of balanced out. This has all the ability to raise its head likewise. Because the food companies are seeing what's happening to prices on soybean oil, that they're used to getting kind of at their call. And you could say, well, yeah, the market's changed. Business is business. Yeah, we'll see how the food companies kind of deal with that. We own half of Ventura Foods. I know that their world is not the same as it was just a year ago, with their ability to kind of source soybean oil quite as freely as they did. And they're the biggest buyer in the country. But here we are seeing just tremendous investments by oil refiners into the production of renewable diesel that's really using only soybean oil as the feedstock. Now, all those investments maybe won't all get done, but a lot are on the board and a lot are underway. All that diesel fuel targeted for California and the western states, it's a tax play. There's a tax benefit to justify it. And so if you're looking for the reason why, it's a tax play. And CHS is not today investing in that renewable diesel, but we may someday if that tax play starts moving east. We don't have any excess diesel to ship to California, so it's not an option for us. But for companies that refine out there, or their product is targeted out there, or frankly, they'll just take it away from another area and ship it out there. Well, we don't operate the place that way. People depend on us. They depend on our product being there, and so our approach is different. But it is really a remarkable evolution that's going on in that business. Now, at CHS, we think, again, to our strategy, we think we're just uniquely positioned here. We have processing, we have soybean oil, we have an energy platform. So as this evolves, we feel really good about our position to capitalize on that as it works. And meanwhile, we are shipping out of Jim Graham's facility, we're shipping more soybean oil into kind of the energy industry than we ever have. And believe me, we like the food industry. I mean, that's our bread and butter. We like the food industry. That's what we're about. But nevertheless, we're shipping more and more into that space. I think we'll always, as a company, be largely into food, but it is it's just changed a lot in a very quiet way. At some point, it's going to make the front pages. I don't know when, but at some point, it's going to make the front pages. It's and by then, you don't know what we're going to have and what we're going to face. This whole body of work, though, is targeted towards what we are all seeing around what words you want to use: carbon, sustainability, climate issues, and that brings me to the point of how we think about that big body of space going forward. What was it, Dan? 2 weeks ago, the board of directors met with management for 3 days just to talk about. I'll use the word sustainability, carbon, but I think you guys know what I'm speaking about in that area. We spent 3 days talking together about this because, the person that says, I've got this all figured out, I know what we should do, I trust them the least. Because I don't think anybody does today. So we brought in some outside speakers, gave us some views, some we agreed with, some we didn't agree with, but we just wanted to hear from some people that could speak to us about what's going on in these areas. The takeaways that we've got from that is, first of all, we have to be engaged in this topic. We, being all of us, need to be engaged in these topics. The trick about that engagement is it is very, very easy to find yourself labeled as defensive. When you want to talk about some facts that go with this or some issues that go with this, it's very easy to find, oh, you're just defensive. You don't want to change. You must probably sell gasoline or something, or you sell fertilizer, or things that kind of provide somebody that shot. When instead, what you're saying at the right time is, okay, let's talk about some of the impacts that come from these decisions or these discussions, and that's not all well received. So it's really something that's a needle that's hard to thread. To be able to bring up facts, not look defensive, so that you're in the room when the decisions are made. And at CHS, we're the largest cooperative in North America. We have a responsibility to represent people that own us. The board has a government relations committee that takes that responsibility extremely seriously and makes all these points in all the settings that they find themselves in. Management does the same. But it is interesting, some of the developments. So being in the room for one thing, getting the facts on the table, tricky. Because frankly, let's just take no-till farming, because people talk, well, the opportunities for agriculture, and there's going to be a lot. But all the no-till farming that's done today don't count. It does not count. Because that's in the numbers today. Their point is we need a lot more no-till farming. So we and others make the point, good idea, yield impacts. Not all soil conditions lend themselves to that. You guys know much more than me on those aspects, but bringing up those packs, so you're going to be defensive. Not being defensive. Saying that there's impacts that come from bringing more acres into no-till than are there today. Energy issues, and Darren will talk about things like electric cars and how we see some of that going forward. But I've said the story at these other meetings. I was at last March or April. I spoke at the North Dakota statewide managers meeting. The speaker right in front of me was their lobbyist. The North Dakota legislature was in session right then. And that group's lobbyist spoke before me, saying the North Dakota legislature had a proposal in to increase the gas tax in North Dakota by a penny. And he got that killed. So he's patting himself on the back, And it was a penny. Minnesota had a nickel in its state legislature this year. It didn't get out of committee. It was a nickel. Look, if people are shutting down work over a penny or over a nickel, you got to get ready for what's coming. And those are all aspects that, those kinds of facts aren't up on tables. At some point, they will need to be. Investment in electrical grid to take on the amount of electrical consumption that I think the country is going to grow into. I mean, we saw what happened to Texas during the storm. We know what's happened in California and with fires and rolling brownouts, and that's with today's demands. So to put more demand on these kinds of systems, it's going to take investment. Investment goes into the rate base. Rate base goes into the power that we all pay at our homes. And so those are all impacts that got to roll through. That isn't to say we shouldn't do it. That isn't to say the country isn't going to do it. It is to say these issues need to get up and put on top of the table, and we look at it as our responsibility to make sure those voices get raised. But we also think there's going to be good opportunities in agriculture, that some of these carbon offsets will be good opportunities for farmers. We got to make sure that they get designed in a way that can scale, that agriculture isn't the one-off. Farmers aren't just the one-off. That whatever system gets developed for carbon trading, if that's what the country does, can handle hundreds of thousands of producers and hundreds of thousands of buyers. So that if a company, and I won't pick one, but if a company has $100 million of these carbon credits up on their balance sheet, their banks know that they're correct, liquid, and transparent. Their shareholders know that they are, and they truly are. Well, if that's the case, then if they came from a farmer that has a certain farming practice that generated that credit that's sitting up on somebody's balance sheet, they can't change anything. They can't change anything. And if they do change someone, they're going to come and take your farm. Why? Because that's the way people get the security and the knowledge that this is true and accurate. That's different than one buyer, one couple of farmers. That's a whole different scale. To do this in a large platform, in a large setting, you got to have scalability. You got to have hundreds of thousands and hundreds of thousands. And for that, that's what exchanges are for. And that's why when you sell your grain on a regulated exchange, you can do so confidently. And when somebody buys your grain on that exchange, they can do so confidently. Is because there is that security that that grain will be there. If that farmer does not deliver, that exchange will go in and cover for it, and then they'll deal with the farmer, or they'll deal with CHS or whomever made the trade. And that's how you get scalability and get confidence in the markets. So I think this is not something, though, that's going to back up on us, ladies and gentlemen. The country is moving up and to the right on these issues. That doesn't mean it's going to be a linear, straight line. There'll be different administrations and different Congresses that make this, I think, evolve at different ways. But we are moving up and to the right. And over time, I think these issues will become a bigger part of our life. So that's why we cannot fall into the trap of being defensive or just pushing back, saying we don't want to change. We've got to acknowledge we will change, but we want to make sure the facts are up on the table. And if there's impacts, we acknowledge it and figure out how we're going to deal with the impact. So I think it's going to be an exciting time. I think, I think people will lean in on these issues, and that's what we heard when the board discussed it. Is this don't count on this backing up? Yep, it might evolve differently than some people think, but it is evolving, and I'm not. I don't come into this thinking that's bad for CHS or for agriculture. I think it's just the world we're going to have, and so figure it out, which is what we're all about. And the board really had, I think, 3 good days to kind of get their own perspective of what's going on in this space, and the fact that there's still 1,000 questions for every one answer, maybe more than 1,000 for every one answer. Just in this time we're in. That's where I kind of come back to somebody that says, I got this figured out, this is how it's going to be. I'll listen to them, but I don't think they do. So, any questions on anything I've covered so far, or just a different view? Different view. All right. Well, like I say, I think all of these areas give me just really great confidence, and I think excitement for the company going forward, for our industry going forward. Customers around the world, I think, are going to increasingly look look to what we're doing on these fronts. And I think it's all leading, really to a nice outlook for agriculture and for farmers. When I talk about the renewable fuels industry taking off and like this, like we were talking about earlier, we're going to build crush as a country. CHS is investing in it. We're just doing it in our own facilities, but you're going to invest in crush. That's going to lead, to opportunities for farmers to have a couple more options than they might have had before. It's going to put pressure on export facilities of where are they going to come up with their beans or their corn that used to be there. They're going to have to bid for it. And I think it's going to just change some dynamics. It also can be very, very good, very, very good for farmers. And we're excited about it. We just think that this is, anytime we have that kind of movement, there's opportunities in there. And there's opportunities for investments and returns that we think could be exciting for us. We're going to stay close with it. And fortunately, the company is in a position where we can invest in it and we can capitalize on it. It's in that position because we made some decisions that weren't very popular and were difficult. The benefit is now, as the game is evolving and changing, we're there at the table. And it's an exciting time to be part of agriculture. So I think I'm going to bring my remarks a bit to a close, and I'll open up for any questions that you might have had on anything I said, or that you came to this meeting on your mind, that you had a chance before we take a break, and then Olivia will come back up after break. Any questions that you had on this or anything else at CHS? Yes.
Switching gears a little bit.
Sure.
That plant down in Fairmont, is that up and running?
It is not up and running today. John, maybe could we bring John's mic up, and can you or Jim just speak to where, I think you're coming up this week or attempting to this week, but you're going to hear from the leader of that area unfiltered.
Yeah, Jay, the plant will come up this week. The plan was to start today, actually, but I think it's more like Wednesday of this week. So we're right on top of go live. And as with any big project that takes that long, there's a few last minute things that have to be done. The team's been working hard. I think they worked all weekend, tidying up some of those last details, but we should be up and running this week. I'm excited to get that plant up and get it up to full rate by the end of the month and be ready for harvest next month.
Well, it's kind of a two-edged sword.
Sure.
Two-edged sword with the CHS, hopefully start shoveling some more money back to the local cause. Speaking of CFS and some of our neighbors down that way, are basically killing our market for soybeans. I don't think we're really happy about that. And, if I'm the farmer who lives out there, I'm going to ship to you rather than CFS or one of the neighbors out there, because it's an economic thing. But our board position, we're supposed to have board hats on today. We're not too thrilled about it, pretty upset. This is going to kill us the amount of grain, we have. We're going to have empty bins because we can't source the beans. Those the motherships to us is kind of the grain divisions actually over that. Kind of where we're looking at.
Now, I see where you come from with the point. We do look at the market opportunity that is there on behalf of all the shareholders, but I understand where you come from from CFS. But again, the board has to look at it from the hats they wear across the whole company and the opportunities that industry has right now that justify that investment. The fact is, we will need local cooperatives to supply that plant every bit as much as there is producers that do deliver delivery.
It's difficult to buy bean down.
Yeah, it is. I just would say that we do need local cooperatives as well as producers for that area, but I get where you come from being close to that plant. I get that point. Yes, sir.
So how do you balance the future investments that you make, like that investment, will have an effect on the local cooperatives? You said you were going to change how you look at that. Maybe go a little bit more in depth, because that can have a profound effect on us and our neighbors. I'm guessing there's going to be more.
Yeah.
You said there's going to be more.
Yeah, and it's just not us, right? It's just not us. I mean, somebody builds a plant up in Spiritwood, North Dakota. That's going to change that market significantly up there. And I think there's just going to be more of that. I don't have a perfect answer for the question. I just don't. Because there is impacts when you make investments to people that are particularly around it. The board, when we bring these investments, kind of discuss what are these other impacts. We think about it because, frankly, we understand those other impacts. Near term for CHS, we think that we have, Fairmont now with this expansion positioned well. We have an investment going into refining to balance that. And we're going to watch what other investments really make sense in those two facilities. There could be more. There could be more. We don't have anything proposed today, but there could be more. But I know that answer comes across as not good enough. I get it does. Because you are located right there by that plant. So I can't say, oh, you're wrong and I'm right. I understand the point that you make. I understand the point that you make.
I think we understand the best.
Mm-hmm.
I think what's hard is, you talk about that ship sitting in the port.
Yeah.
You talk about that train sitting on the
siding.
But at the same time, we're the ones sitting at port or could be the ones sitting at port or on the tracks. And, it's a tough balance.
Yeah. Now, I would say this is, I think for us as a team, I think the pressure that I'll put on our own staff is what can we do with Merlin and his team at a better level than we've done? I don't know that, it's not like we got this answer, we just haven't told you yet. It's not like that. But I want to assure this board, I want to assure this CEO, we're going to lean in with both shoulders to do what we can. And if at the end of the day there isn't something that works for both, I guess that'll be an answer. I'm not giving up on that. How can we do something that is better for both of us? And I don't have that answer, and I don't think it's an easy one. But I'll commit you this: we'll throw both shoulders behind finding and looking.
So is that a part of the operational excellence that you're looking for?
It is, because that goes to, I used, the country operations thing with grain as an example. I put, how do we work with local cooperatives in a more vertically integrated way as another example? How do we do that? It's complicated because you got two separate companies. You can't get away from that. There's two separate companies, so it's complicated. You got to respect two different companies, because I think there always will be two different companies. It's not all going to be just one, so there's going to be two. So how can you work with both? It's complicated, but so it's hard. That's what we're paid to do. Let's try to figure it out, even if it's hard. And you have my commitment. We will work our best. We will not ask somebody to do something that's not good for them, because that's just a headache waiting to happen. We'll work hard to find a way that's good for both, but it is hard. It is hard. Yes, sir.
Hey, I'm Jeff Brown from Washington, Minnesota.
Yeah.
Got a question on how has CHS, how do you look at working with partners on foreign soil operations on foreign soil? What we've done versus what we've done in the past.
Sure.
Where we are now, where we're headed.
Sure. So for the people that are online, let me make sure I repeat it kind of, is what's our approach on investments outside the United States, foreign soil in your words? How does it compare with what we did in the past, and how are we doing it today? Fair? So since 2017, I came into this job. One of our first topics with the Board of Directors was, how do we rethink what we're doing internationally? John Griffith kind of came into his role, and what we significantly changed from a past approach is when we have an investment internationally, and we don't have a lot. Most of our investment internationally is in people. But when we have an investment internationally, we have to be able to draw a straight line of how it's good for the U.S. farmer. How is it good for the U.S. farmer? So what does that mean? Because it's kind of a little bit of a confusing statement. Let me give you an example of something that John, we think would be something that isn't good for the U.S. farmer. We as a company do not invest in a crushing plant in Argentina that would buy Argentinian beans and sell meal into the Argentinian farmer. Might be able to make good money doing that. I don't know. But it's not an investment that we bring forward to the CHS board because we can't see how that's good for the US farmer. Might be a money-making deal, might be. And I guess, well, if your job is just to make money, I guess maybe that would answer that question. We don't look at it quite that way. So what would be an example of something now that is good for, that we could say for the US farmer? So why are we international? We're international because we know that as a company, we have to be able to source supply for what the market conditions are at any year and any time of that year, let alone the fact that the US generally is in the market for Asia, call it September through February, and then it flips to the Southern Hemisphere for the remainder of the year. So if CHS has no capabilities there, that means we're out of the market for half the year. We will not be a dependable supplier to customers. And so frankly, it's just going to be price that gives us the bid because you're not dependable, CHS. So that's why we have international. So an example of an investment internationally that would be good for the US farmer is how are we going to get beans that we source to our customers around the world? So we will invest in things like a commitment at a port facility so that we can export it. Transportation commitments that we need to make to be able to move it. So that's an example of something that we can draw a line to how it's good for a US farmer because it allows us to operate in those facilities. And without that, we really couldn't operate. We wouldn't have the ability to export. So that's how I would answer your question. We've gotten away from just investments that are just within a country that we just, and believe me, other grain companies do approach it if there's money to be made crushing beans in Argentina, let's do it. I don't take anything away from them. They're great companies. They're probably good investments. I don't take anything away from it. We're not using our owner's equity for those kinds of investments. We just don't. And we don't anymore. So John, in some of his early years, had the charge of getting rid of some facilities that we had been doing that in. And that's been cleaned up. Does that answer your question, sir? Any other questions before we take a quick break for some coffee and 5 or 6 rolls each over here? Yeah, Todd.
Jay talked about changing kind of philosophically how you're going to judge locations. Mm-hmm. So are you going to restructure incentives?
So the last part I couldn't hear.
Do you restructure incentives to make sure that the location, if they're not ultimately getting that last cent from north and south, are you going to restructure incentive programs or how?
Yes.
How do you get that done?
Yes. Yes. It includes restructuring incentive programs, but you know what, Todd? People kind of reach for their incentive program really early that, I probably repeat for the people. So the question was, if we're going to change some of these operating models within our retail locations, do we change things like incentive programs to help do that? Fair, Todd?
Yeah, how far up?
Yeah. So it goes, in fact, we've begun at the highest levels. That's where we've begun. And we're pushing that down. So we are changing incentive programs to bring that, frankly, that incentive for the whole company to do better. But we are still having a portion. We need that individual accountability at a location as well. So we're not walking away from that because, if we invest money into a location, there needs to be pressure that performs. So we're not walking away from it. I would just say this, though. Many times incentives are the first thing that one looks at. Well, you can't make these changes because the incentive programs aren't aligned. I say that's right, and we'll get that fixed, and we'll get that straightened out. But more times than that, Todd, it's because the leadership wasn't aligned. And we're through that. As a team, we are aligned. Rick Dusick represents the views from those locations to us every day. But he comes to it in a way of how can we make this happen? How can we get this done? Not, don't screw with my operations. How can we get this done? And sometimes what we thought was an idea to do it is wrong. and there's a better way to do it than what we might be proposing. So I would say incentives are changed and are changing, but I'm probably more leaning on leadership is aligned that we need to make some changes to make this place a better company. But it's heavy lifting. It's heavy lifting. It's a lot to get underway, and so that's what we do. Yes, sir.
Is there a potential to source more corn out of south central Minnesota for the export market, or is livestock prevents that and lack of direct rail or whatever?
So John, I'm going to ask you to take this question again. So the question for the people on the line is there an opportunity to source more corn out of south central Minnesota for the export market, or does internal processing or animals take most of it? Fair? Yeah. So John, you want to hit that? John, for those that are on the screen that maybe not see, John Griffith, who leads global grain and processing and CHS hedging.
Yeah, thanks for the question. I think you got to start with the fact that the commodity markets are extremely efficient already. And so the grain will flow to its best market naturally. We do work with railroads and other transportation modes to try to enhance the access to export markets. Perfect example, this past year, we worked with the UP Railroad to have some better direct access to our Myrtle Grove, Louisiana facility. That was, some small increments, but it was progress towards exactly what you're talking about. But there's an awful lot of southern Minnesota corn, specifically to your question, that gets used in the local feed markets and the local ethanol markets. Some of it can find its way to Southern California feed, and we're probably pulling my example as the last one to get it down, because there's other water transportation and other competitive origins to source that to the Gulf of Mexico. Hopefully that answers your question.
Other questions people had? All right. Well, let's take. It's not your last chance. We still got more for the meeting, but let's take. I showed just 20 of 11. Maybe we can try to be back at 5 of 11, and Olivia Nelligan, our Chief Financial Officer, will talk some numbers with you. So with that, help yourself to coffee and drinks, and we'll see you back in about 15 minutes. Thank you. All right, our featured speaker today, Olivia Nelligan. Olivia is the Chief Financial Officer for CHS. Olivia has been with the company about a year and a half now. She began at CHS, and then about 20 minutes later, COVID hit, and so things just changed. But you've seen her on the annual meeting if you watched it on video and participated that way. But she's been just a tremendous partner to me, to the executive team that's here with us today, and with her work with the board of directors. So we're just really thrilled that Olivia is part of our team. And she's really thrilled that she can talk about third quarter results and not second quarter results. but that we have to talk about it all, no matter what it is and when it is. And that's just the way we are. So with that, I'll turn it over to Olivia Nelligan. Olivia?
Thank you, Jay. Good morning, everyone. It's a pleasure to be here with you all. I've been doing these owners forums in our different parts of our trade territory over the last number of weeks, and it really has been a wonderful experience to come out, meet people, hear what's on your mind, and get to understand a little bit more our roots in the country and what makes everything tick. So I've enjoyed visiting with some of you this morning. So hopefully as the day progresses here, I can speak with others. And for those that are tuning in virtually, hopefully I get to meet you in person at our annual meeting or other events. So I'm going to go through the financial report for our third quarter and the 9 months ended May 2021. I'm really happy to report that we have made significant progress as the year has progressed. And these third quarter results, they're actually our strongest financial performance for a third quarter since 2014. So just very happy with this quarter. As Jay said, much nicer doing it at this time of the year than it would have been a number of months ago. So what you see on this slide is a summary view of our net income, our pre-tax income by segment, and for our corporate and other category for the 3 months ended May 2021. So we'll start with energy. For energy, we had a pre-tax income of $5 million versus a prior year pre-tax loss of $54.7 million. So a year-over-year positive change for the quarter of $59.7 million. So a number of drivers of this. Overall, our revenue and earnings improved significantly over the fiscal 2020 third quarter, but also over the fiscal 2021 second quarter. So again, that improved performance as the year has progressed that we like to see, and really it's been as volumes and margins have started to recover as a result of the pandemic. We've just seen that continual improvement as the year has progressed. We saw higher refined fuel crack spreads, which is the price differential between inputs such as crude oil and our refined products. And that gave us some of those third quarter margin gains. And our comparative profitability was also helped year over year by the non-recurrence of a $42 million non-cash charge to value our inventory to its market value in the third quarter of fiscal 2020 that didn't reoccur in fiscal 2021. We did see less favorable pricing on heavy Canadian crude oil, and we also experienced exceptionally high costs for RINs, or renewable energy credits, which we're required to purchase under the Renewable Fuel Standard, and that was an adverse impact year over year for the quarter of $82 million. Moving on to our ag segment. The ag segment reported pre-tax income of $140.1 million versus the prior year of $95.3 million, a year-over-year positive change for the quarter of $44.7 million. This significantly improved performance in the ag segment was attributable to a number of factors. We had strong global demand, especially from China, and that drove prices up, but it also resulted in higher volumes, especially of corn, and John will talk more about that. We also saw strong demand for oilseed, both as into the food market, but also, as Jay mentioned, as a feedstock for renewable diesel. And that demand, again, significantly improved those ag earnings for the quarter. We did see a partial offset to those strong margins through temporary mark-to-market losses, and we expect those to reverse here in Q4 and into 2022. We had increased volumes of agronomy products, also stemming from stronger demand given favorable weather conditions. And we also saw increased equity income from our joint venture investment in Temco, our grain export facilities in the Pacific Northwest. Our nitrogen production segment represents our investment in CF Nitrogen. We saw pre-tax income of $46.6 million versus prior year of $23.5 million. So a positive change for the quarter year over year of $23.1 million. This stemmed from increased sales prices for urea and urea ammonium nitrate, or UAN, which those are the focus of our commercial relationship with and our equity distributions from CF Nitrogen. Our corporate and other category had pre-tax income of $64.4 million versus prior year of $6.3 million. So a positive change of $58.1 million. Maybe as a reminder, what's in the corporate and other category are CHS Hedging, CHS Capital, and then we have our joint venture investments in both Ardent Mills, which is a leading flour producer, and Ventura Foods, a producer of edible oil-based branded and private label food products. And the year-over-year change is largely attributable to Ventura Foods, which saw a much improved environment for oils and a recovery of demand that had been lost during the early stages of the pandemic. Our pre-tax income in total, $256.2 million versus prior year of $70.4 million, a positive change year over year of $185.7 million. Our income tax benefit for the quarter was 17 million. And that is based on the mix and the amount of our full year earnings projected, as well as our equity management assumptions. So in total, our net income for the quarter was 273.5 million versus prior year of 97.6 million, a positive change year over year for the quarter of 175.9 million, which is a 180% increase for the third quarter. Moving on to the 9 months. So before I delve into the numbers here, maybe just as a reminder, 2020, our first 6 months of 2020 was pre-pandemic. So that was through February, and we were having a really nice year in the first 6 months of 2020. So really, when you look at these comparisons, just bear in mind that we're looking at 3 quarters of pandemic impacts on the energy business in 2021, whereas in 2020, it was really just 1 quarter that was impacted by the pandemic. So looking at our energy business, we saw pre-tax income or pre-tax loss of 116.9 million versus the prior year had pre-tax income of 246.3 million, a year-over-year change for the 9 months of 363.2 million. And just again, just really the pandemic having a massive impact on volume and demand in this year over last year. And I mentioned RINs when we looked at the 3 months. For the 9 months, the impact of those RINs costs year over year was 145 million. In our ag segment, we had a pre-tax income of 237.1 million versus prior year of 60.6 million. So a year over year positive change of 176.5 million year to date. Nitrogen production had pre-tax income of 62.2 million versus prior year of 45.6 million. So a positive change year over year for the 9 months of 16.5 million. And our corporate and other segment, we had our corporate and other category, rather, we had pre-tax income of 112 million versus prior year of 31 million, a positive change year over year of 80.9 million. Again, the main driver there is the strong results from Ventura Foods. We had an income tax benefit in the first 9 months of 10 million. And our total net income for the year to date is 305 million versus a prior year of 401 million. So a positive change year over year of 95.9 million. So Jay spoke earlier about coming into this year and some of the decisions we made. We knew that we were going to have an unprecedented year and a very challenging year based on what was going on in the energy business. And we did take very decisive and necessary action at the start of the year to really protect our financial health. And Jay mentioned some of those steps that we did take, but we've been working really hard as a team to take over $100 million out of our budgeted costs. And that has really helped boost our profitability this year. But we didn't just take a look at costs, because you can't cut your way to prosperity. We know that's not sustainable. We have to invest in our business for the future, to keep it strong, to keep it safe, to be competitive in the future. So we really put a big focus on cash flow. We had goals across all of our teams to improve our cash flow year over year, and to really focus on optimizing how we leverage and use cash in the company, and to reduce our cash conversion cycle. And I'm really happy with the results of that work. It has really improved our cash flow position this year. That's been really important in this year in particular. We all know we saw rising commodity costs on our ag side. It meant that we had plenty of liquidity to stay in the market, to optimize our margins. And it also meant that we've been able to borrow less, and we'll pay less interest than we otherwise would because of the work that we've done on cash flow. So all of those steps, in addition to our strong third quarter performance, is really what enabled us to approve the extra cash out to the country that Dave Johnsrud spoke about earlier. As we've mentioned earlier, the CHS board approved an additional 50 million in cash returns to owners. So this last week we pushed those checks out. So for those people that are on getting checks, the associations, they'll receive those in the mail this week. And for those that are on ACH or electronic payments, those payments were made last week. So that 25 million being sent out to our associations. And then we also set aside an additional 25 million to meet those requests as they come in from eligible producers age 70 above and estates. So in total, total redemptions this year approved of 83 million and total cash authorized of 113 million for returns to owners. And we're just really happy that we've been able to do this, because if you had asked me after the second quarter if that would have been possible, I probably would have said no. But the board has been very focused on keeping that issue in front of us, and we're just really happy that we've been able to do it. So thank you very much for your business, and we appreciate it very much. So overall, the message I want to leave you with this morning is that CHS is strong financially. We've good momentum going into the fourth quarter. We've a lot of reasons to be optimistic and to be proud of our results thus far. And I'm optimistic about the years ahead. So thank you this morning for your time and attention, and I'm happy to take any questions you have on our financial performance. No questions? Well, I'm around for the rest of our time here, so find me if you have any other questions.
Thank you, Olivia. Let me just make a plug in. You heard Olivia speak about the fact that just in last week, the checks were cut and ACH were sent. Let me just make a plug for those of you that are still receiving checks from us. We would really like it if we could get that part of it changed too, and get that into ACH. So it's not just around a 51-cent stamp that we put on the damn thing. It's because of everything that we have to go through to get checks issued. So when we talk about being a better company and trying to take some costs out in different ways, this is an example of it. Some of it's flashy stuff that shows up in annual meeting reports, but some of it is just this quiet work that goes on around trying to do things in a better way. So let me put a plug in for it. If you don't know how to do it and you're getting checks, Olivia's going to be here. We'll get somebody calling you this afternoon if there's a way to do it. So let me just put a plug in for that. Thank you, Olivia.
Thank you.
All right, maybe if I can get the business leads that are with me traveling today to kind of come up and join me on the panel. We'll see what order they sit in. I never quite know. Oh, you drew the short straw, John. So this is a part of the session. I'll maybe have a question or two for the people to get the process started. But whether they speak about something that was on your mind or not, you're free to ask, and as well as the people that are watching online. If I assume out there you've got some way of communication to send us in questions. I've got 2 here that were sent in, but through the magic of technology, it'll show up on a printer here and they'll walk up. And so this is the way we do it at annual meeting. You'll get that live question here and we'll take them as they come. So in both forms, whether you're on the virtual online portion or here in place, we'll have a question. Maybe can we just start with for everybody just to get who these individuals are. So John, could I start with you in terms of who you are and how long you've been here, and we'll move down the line.
So hi everyone, I'm John Griffith. I lead the Global Grain and Processing Division and the CHS Hedging Divisions of the company. Been with the company a little over 20 years and grew up on a small corn and soybean farm in southwest Minnesota, just outside of Tracy, Minnesota.
I'm Rick Dusek, and I lead country operations for CHS. I've been with the company about 33 years and spent some time in our global grain marketing business and agronomy, and more recently in country operations.
Good morning, everybody. Darren Hunoff. I lead energy as well as work with Cooperative Resources. Tony and Jen are in the room. I've been with the company for 29 years.
Good morning, Gary Halverson. I lead agronomy for the company. So our wholesale crop nutrients, crop protection, our investment in CF nitrogen. I've been with the company since 1999.
All right, I think, Gary, you'll draw the short straw this time, even though you're on that end. We're going to start with you. So let me just say the topic that I think I'd like to start with is what's kind of on the top of your stack of things on your desk right now in terms of what you're working on or what you think this group would be interested to hear about. That could be a little bit short-term oriented, but may not be in the next 3 months either. Just what's rising up to the top of your stack?
Well, Jay, what comes to mind for me, and probably on everyone's mind, is high prices. We've gone through just an incredible rise in prices of crop nutrients products, born on the back of just unbelievable global demand. If you look at the global urea market, generally over the last few years, it's about a 50 million ton market globally. And that'd be a period of time from 2015 to 2020. You'd say it's about 50 million tons of urea that gets traded. This last year that we just finished, this crop year, was 54 million tons of urea that was consumed globally. And so that kind of demand just has pushed prices higher and higher and depleted stocks. Just last week, the Chinese government has said that they're no longer going to be exporting urea. So that's more urea that's not available to go to places like India or Australia that would normally consume the Chinese production. So they still have an appetite in those countries, and those counterparties will still be in the market buying. And that leads us to believe that we're going to have really, really strong prices on bullish markets through this next crop cycle of 2022. Not what a lot of farmers would love to hear, but the way the supply and demand is working right now, there's just a lot more demand than there is supply. And so we're going to see strong fertilizer markets through next year's planting. We're also seeing disruptions in our crop protection supply chain. And for us, that means that we're going to be investing in inventory sooner and trying to best guess what products we need to put on the floor. Matt Swecker and I were having a conversation earlier about supply challenges in 2021, a lot of allocated products, a lot of products that simply were out of stock. And we're going to see that trend continue in crop protection for 2022. And so we're working diligently, and our teams are working diligently to make sure we're putting the right material on the floor, looking forward to 2022 to make sure we take care of our channel in the cooperative system and ultimately the American farmer.
Gary, some of your supply challenges, interestingly enough, kind of came from the cold snap that hit Texas. How would you kind of weigh that with freight issues and, container ships off the port of Long Beach that can't get unloaded and so forth, but that also impacts. So, how would you kind of describe your supply issues going forward? Still related to a cold snap or more related to kind of global shipping operations?
Jay, I think it's multiple factors. The winter storm Uri didn't stretch supply chains, it snapped it. And it did cause a backlog at places like Long Beach and New Orleans with container vessels that were holding active ingredients that should have been reformulated into the products that we all spray actively. So that was one factor. Second factor was COVID in places like India and China, large production centers for those same active ingredients. And they were very impaired because of the COVID virus and their ability to keep their teams working and keep those facilities working at nameplate. And I would tell you another factor that we really think is going to weigh on these markets going forward is China will host the 2022 Winter Olympics. And we know how they behaved in 2008 leading up to the Beijing Summer Olympics. They shut down a lot of production to try and get a better air quality standard prior to inviting the world to their country for the Olympics. And we actually anticipate we're going to see some of the same activity through this next cycle as they prepare for the 2022 Winter Olympics, shutting down production and thereby constraining our supply, all in an effort to put on a good face for the world.
Still a lot of coal-fired production.
A lot of coal-fired production, for sure.
Darren, same kind of question. With energy, again, you may even think a little bit longer term than the next couple of months, given some of the topics in the face of the energy industry right now.
Yeah, sure, Jay. Well, a couple things I think would be interesting. Before we get to the longer term, clearly, even with the recovery that Olivia showed in our financial results, The energy business is not out of the woods, so to speak, yet. So as you can imagine, we're keeping our eye on the road pretty closely. There are some really positive things that have been happening in the market I think would interest you. Our gasoline sales have been pretty resilient through this, but we've had 4 months in a row now where our branded gasoline sales have been ahead of forecast, ahead of previous year. So from a CHS lens, that's really signaled recovery for us and led to some of those results. From a more of an industry basis, something that we watch really closely is how are the countries, not just CHS's, but how are the countries' refineries running? Refinery utilization rate is really a signal of the health of the industry, so to speak, kind of inside the refinery gates. And for much of COVID, it was as low as 60%, and the industry just can't make net income at that kind of utilization rate. We're back up into the 90s now as an industry in the US, and that's a much, much healthier position. The plants that you own and that we work hard to safely operate every day didn't ever get to those levels. They've been operating safely at 90% plus for the most part through the whole ordeal, and continue to run well today. A little longer term, as Jay alluded to in some of his comments, a lot of change on the horizon in the energy space. And I think that's probably not a surprise to anybody in the room. So we've really invested a lot of time in the last 6 months thinking much more deeply about what's the future of this business look like? How could this world play out? And a couple things we take away from that. One, there is no one way it's going to play out. So we've come to think of it as it's almost impossible to get to certainty on how this could all unfold. But we have kind of put some boxes around some scenarios. And I'll tell you what's common about those scenarios. One is something I've been telling rooms like this for a while. It's unlikely we're going to sell more gasoline in the future than we did in the past. It's all about, how fast is gasoline demand impacted in the country, maybe even the world, but for sure in the country. And all the scenarios we have between electrification and quietly efficiency of the existing modern gasoline engine, in all of those scenarios, we have less gas to sell in the future. Interestingly, diesel fuel is pretty resilient. We don't see in our planning work, even a decade out, that you're going to substantially use significantly less diesel fuel when you plant a crop. Now, you use a lot less today than you did 10 years ago. We think that may have plateaued a bit. You think about heavy horsepower, heavy torque applications like construction and other applications like that is more a product of the economy than it is electrification at this point. We'll see if that changes in the future. So it really creates an interesting set of scenarios for us and for the whole industry. How can we continue to supply a secure supply of diesel fuel for your needs and for our owners' needs? But then what are the other ways that the gasoline make changes? What other uses might emerge? And I don't think it'll be any one, Jay. It's going to be several, and time permitting, we can talk more about that. The third thing I want to quickly mention is in our propane business. And for those of you that are in the managing local cooperatives, I'm sure our team is talking with you a fair amount about this, have been for a while. But propane has truly become a global commodity. As we sit here today, out of every 10 gallons of propane that's made in the country, somewhere between 7 or 8 of them could be put on a ship and exported. Hasn't always been that way. I've been around that business a long time. We didn't spend a lot of time talking about that even 5 or 6 years ago. But today, that global market is really pulling propane out of the United States until the demand calls for it. In the past, when the demand called for it, we were building inventory all summer long to get ready for it. In today's world, that inventory can go out of the country. So that means we got to double down on our planning, double down on looking at how much storage needs to be out in the field, and all of those kinds of things for a changing market, Jay.
So, Darren, we've always kind of understood that we couldn't decide on propane supply when a farmer is ready to flip the dryers on. That's way too late. But now it's probably even earlier than it had been to kind of, frankly, make a call of what you're going to need for dryer demand or heating demand. That doesn't make the decision easier, but frankly, you got to decide earlier.
No, it certainly doesn't make them easier, Jay, and that's why I just kind of use the words double down. You can put the word earlier in there, I think, is a fine point. Because the way that supply kind of built in the country and then moved out is just been greatly impacted. If you're a propane producer, which we're a very small producer at our 2 refineries, and we quickly sell that to you all really fast. We're frankly more of a buyer of propane. But if you're a producer of propane, you just want it gone. You want it out of here at the best price. You're not real interested in storing it unless the market really rewards you for it. So they frankly don't worry a lot about whether we're going to dry corn or whether it might be cold in February. We have to worry about that together with you and play a role in that planning.
Richard, maybe I could ask you the same thing, but I think you'll kind of address this not just from your own operation that you oversee for the company, but also just retail in general. How you see investments, technology, people, 100 things.
Yeah. So yeah, Jay. So the way I think about ag retail, and there's a lot of us in this room, is there's a changing environment out there. And we can talk a lot about competitors that are coming in and doing it differently and really, causing a bit of a disruption in the market. And I think the one thing that's common in all those different companies coming in is they're working on connecting to the farm, to the global marketplace as seamlessly as possible, and often using technology. And that's a driver of change. And I'll use one of Jay's things that he questions us all the time is, do we see this world getting less competitive in the future or more competitive? And I think we all get to an answer very quickly that says it's going to be more and more competitive. So we need to find ways to be more efficient, and we need to find ways to grow. And I think about it in 4 different terms, regardless of where you are in the retail industry, is number one, focus on the customer. And I think, this is a relationship business. And I have a family that farms, so I know how important it is to have a relationship with your local people that provide you goods and services. But there's also technology that's coming into play and customer relationship management tools. And I look at all those things as tools to help us enhance that relationship. We can never lose sight of that relationship. It's precious to us. And those of you that run your local cooperatives, I know you feel the same way. We've got to make sure whatever we do, we hang on to that strongly, serve the customer well. Second is around asset optimization. What are those assets we need in our businesses to run our businesses well? And I was talking to a board member of a local co-op just this morning as we're having a cup of coffee getting ready for this meeting. And he was explaining to me how, we've had to rationalize some businesses. We were in some businesses that we maybe didn't belong in, taking a lot of time, taking a lot of energy. They weren't our cores, to use his words. And I look at it the exact same way. And that's what we're doing in Country Ops, is we are rationalizing some assets to make sure that we can focus on growing where it serves the enterprise. And that's my third point is, I think as time goes on, whether it's country operations or a member co-op, think this industry's got to start aligning itself better, because we all know the history is we all sit there with our cards at our chest, and then it's about the price. What's your price? Will we conduct business or won't we? And what we've started to do internally is say, let's focus less on that and let's focus on the entire marketplace. What's happening over in China with John's team, and what's happening with the farmer, and how can we connect that supply chain, being more fully transparent and looking at the real market. And instead of spending our time on this one transaction, let's spend time on how can we get more business, how can we buy more grain and run a more efficient system. And I think there's a lesson there for the entire cooperative system as we go forward and battle these new competitors coming in that aren't going to go away. And we're going to have to find ways to be more efficient. And then finally, the fourth point, and you'll all nod your head when you hear this one, is it's about talent. Hiring, developing, and retaining talent. And right now, way too often, I know internally, we have somebody retire or leave, and our choice is, well, let's post the job and see what we get. We can't live that way any longer. We just can't. We've got to start building a bench and do better at developing. And it's hard work. It's really hard work, but we're going to have to lean in. And I know I speak for the entire cooperative system on that, because I think our greatest challenge is having the right kind of talent with the right skill set to lead these businesses go forward. So that's how I think about retail, Jay.
Yeah, and I think for sure the talent is first and foremost. I just want to also give a word of support, given that there's CEOs in this room and their board members. Is the CEOs many times find themselves in front of their boards talking about facilities to shut down, assets to sell, something that needs to be changed, that's frankly going to be unpopular. I think I can speak for those CEOs because I know we do it, and each of these people have to do it in front of the CHS board. No, that's not the highlight of their week. When they got to stand in front of a board and say this needs to really be changed or go. They didn't wake up that day thinking, I'd like to really talk to my board about this. We understand these are hard decisions. They're not popular. At the end of the day, I end up coming back to the point that I make with the CHS board as I make with this group. It's a good thing we're in the leadership business and not the popularity business, because it is the decisions that need to be made for the benefit of the firm going forward. And they can be very unpopular. But let me give a vote of support for the CEOs that have to make those presentations in front of boards, because it's not easy. It's hard. It didn't make their day to have to do that. The only thing worse than making a presentation like that is not making a presentation like that, because if there's too many instances where people have not made those tough decisions, and then then you're in a bad spot. So I would just, in addition to the town side, very much support what Rick had to say. John, there's not much going on in the grading business around this world, and things are quiet, and it's just an amazing spot when you compare ourselves to 12 and 18 months ago.
Yeah, certainly, Jay, and stack weather on top of that, and gives us a lot of uncertainty going forward. So first, I'd at least acknowledge that in a large portion of our trade territory, everyone's looking to the skies for rains. Over the weekend, we were traveling together like last week, and we saw this big system on the radar screen, and we thought, wow, that's going to be a really beneficial rain. And I called home over the weekend down in the southwest part of the state, and said, Bill, how much rain did you get from that big system? And it was 2/10. And that was half of the amount of rain they got in the entire month of July. So, and the crop remarkably still looks okay in that immediate area. So, but how long can you keep saying that? And I think that's the case in a lot of areas, and it certainly warrants a lot of attention because it'll have a huge impact. And it have a huge impact because the second thing that we believe still to be true is that the export market will continue to pull pretty vigorously at grain supplies, particularly going to China. It's been kind of quiet lately here, Jay, on China buying soybeans. They've been holding off for good reason, because futures are high price, basis is on higher end of the historical norms, and vessel freight is really expensive. So if you're a Chinese crusher, you're looking at a $6 or $7 a bushel price increase on the soybeans, and as much soybeans as they buy, they have to figure out who's going to pay that $30 billion price increase that they're faced with. So there's some hesitancy for sure, but we believe they're going to come back and have to buy these beans. We just hope that we get a little bit of rain to help supply that. That export market is so important to our price. That marginal export has a disproportionate impact on the price for the amount of volume that goes to export. And we saw that this last year in corn, when China came in to buy fair amount of corn, 25+ million metric tons. So like 1 billion bushels of corn they bought this past year. It was hugely impactful to not only the corn market, but the whole commodity complex. So it's really, really important business. And we think that will continue going forward. We think there's been some structural changes in China. Feed rations for hog production have changed with their new way of managing African swine fever in more of a confinement space. And so there's a big shift in the rations that include more corn. There's more ethanol production in China for a cleaner fuel as well. So, and we did see some evidence, lately of them buying some corn for December through March. And so it gives us reason for optimism with real transactions. We'll continue to see that. And the last thing I'll highlight that makes the top of the desk, and Jay's talked about it a lot already, but renewable diesel, and I'll just put a finer point on, there's 25 billion pounds of soybean oil produced in this country today. About 1.5 billion of that goes into renewable diesel today. We think over the next 4 years that will grow to 7 billion pounds. Now that's a huge shift on a percentage basis of the total pool of 25 billion pounds. So there's going to be a lot of shifting of where the flows are, what's going to fuel. As Jay said, we're doing a little bit more in fuel. We're largely into the food, but we're doing a little bit more into the fuel just because there's a strong tug. And the food industry is not going to back off, and we certainly have strong ties into that industry with our joint venture in Ventura. We're doing more with them as other suppliers have opted a little bit heavier towards the fuel side. So there's just a lot to sort out in that industry, but it's been good for margins too, and will continue to be good for margins and expansion in that industry across the nation. So those are the three big things that are on top of my mind, Jay.
John, maybe you could speak a moment. I think Olivia referred to it just a little bit in our financial performance. We see these things called mark-to-market impacts that hit our financials. And maybe from Olivia will make sure the financial statements are perfect. I mean, that's not going to be a question. We will make sure that is right each time we close up a month in a quarter or a year. But could you speak just to some of the drivers that hit these mark-to-market impacts from a business perspective, and how you think about them, and the fact that those drivers don't care about a month end or a quarter end or a year end. They do what they're going to do. And some of you in this room are close to that kind of impacts on your own income statements, but also some people on the video, or maybe aren't in that business, kind of hear those words, because you're going to see them in many times when our quarterly announcements. And if you could speak from a business perspective, what drives those kinds of impacts to us?
Yeah, certainly with the volatility in vessel freight and the volatility in the commodities this year, we've seen probably more mark-to-market impacts on a month-to-month, quarter-to-quarter basis than we've seen in a while. To give you a couple of specific examples, vessel freight off the P&W went from $27 to a little over $40. Well, that amount of money impacts the sales that we have on the book. So we've got soybeans sold into China, delivered to China, and vessel freight goes up. Then the price of soybeans in China goes up, and we've got a sale on the books. So that turns into a bad guy in a big hurry temporarily until you execute against that. So we take a pretty negative temporary mark-to-market in that particular example. The other big one that we've seen is related to our processing business, when the pull on renewable diesel propped up the prices of oil to numbers that people that have been in the industry far longer than I have never seen. By a factor of 10. Well, we selling soybean oil out into the future, and as those basis prices rise, we take a temporary mark-to-market loss on those. And as I said, it's at historic highs by a factor of 10 versus what we've seen in history. So all of those future sales that you have on the books in that environment, you take a temporary mark-to-market loss on that sale. So those are two of the areas that, from a month-to-month basis, it creates a lot of noise. In the end, when you execute against it, the money all comes back. You actually have wider margins embedded in that mark-to-market when you execute, and more money comes in. But you have to get through time and quarters and year ends. The market doesn't respect those milestones.
So when you look at CHS, I mean, we as a company, we really don't have any businesses that have the benefit of the pandemic, and some companies do, and I tip my hat to them. That's great that you can have benefits from a business perspective. We don't operate in those spaces. We got an energy platform that's really got it in their forehead, coming back, against them, and then we have some market impacts, but let me assure you, we do not lose sight of our responsibility to perform. I don't care if it's in our forehead or not, we have a responsibility to perform. And at the same time, we take steps that sometimes can be difficult as we see the circumstances that are in front of us. But the board also has the courage to take those same steps, and we're just committed to do that. This company's made those same kind of decisions for the last 90 years, and I got a good feeling they'll make it for the next 90 years. Because we together, management and the board, think of it that way, and not just quarter to quarter, not just year to year, but making sure we're keeping the company strong going forward. I have more that I can kind of get this group go up on, but I want to first get to any questions inside this room that either something they said or something that you came to town on your mind. I want to make sure that's the first priority. Yes, sir.
I think it's pointed at you, Gary, you probably know best. Recently, Mosaic did the lawsuit, anti-dumping, now one of the partners, CF, is doing the same thing with 28%. I view it as holding the markets up there. What's CHS's viewpoint on that, and how do we interact with that?
Gary, can I get you just to repeat a little bit of that question for the people online?
Matt Swecker is asking a question around Mosaic's countervailing duty that they filed against anti-dumping for theirs specifically was against mostly Morocco, but some other Middle Eastern countries. And then what's our response to CF, who's also filed the same countervailing duty suit, and how do we think about that in that we're partners with them? Well, Matt, thanks for the question, because I think it's important to talk about, but it's complicated. CHS is absolutely for free global markets that can work. And at the same time, we have to be responsible stewards in looking at how things are produced and what those subsidies mean. In the case of Mosaic, and theirs was adjudicated, they actually won their countervailing duty. I can't really comment about CF because there's about 10 hoops for that thing to go through before that'll be final. But Mosaic did have a positive, in their view, positive result from the countervailing duty. The ruling was that countries like Morocco were getting unfair subsidies from their king in terms of their production costs. Then those products landed here were an unfair value that Mosaic couldn't reach. I would say Mosaic in particular has a hard road to hoe because they're a mining company in the US, and that in itself, with the amount of burden that they have for environmental regulations, the taxation they have per ton, the Jones Act works against them and their ability to use intermodal waterways and compete here in the US. So, it's a tough situation. And, our position is we want free markets that work. And not to really say whether it was right or wrong in the way that the courts ruled in regard to the countervailing duty, but it's best for America when we can import values of any goods at a value that's competitive and export in the same way. And so, to the degree for the American farmer, largely unfortunate, but it's the way the courts rule.
Thanks, Ben. Darren, one for you. This is coming in online, just for the room. And I think Olivia referred to RINs as part of our cost of goods and the impact that we're having. Just a very straightforward, simple question is why can't we blend more ethanol and biodiesel to reduce the number of RINs we have to purchase? Very reasonable question.
Yeah, reasonable question with a reasonable answer. We can. We can. And doesn't go quite that easily. We're going to blend as much as the people that buy from us want to buy those products. But we are absolutely taking steps to blend more, particularly on the ethanol side. We're up, as of today, actually, we're up to 30 terminals, 31 to be exact, across our system where you can buy E15 pre-blended, take it right to a station that no longer has any kind of encumbrance of brand standards that say you can't put E15 in. So we've removed those kind of brand standard issues. And then we've worked with both the New Star and Magellan pipeline systems, which are the huge arteries up into this part of the country and really all over the major part of our country that we supply for that intent, to blend more. So our intent is to do so. That's one of the things we can control. There's a lot of things about the RIN, Jay, we can't.
So, I think your area has provided leadership in terms of getting things like E15 going, which, these aren't the political headlines. You've got the reality of working through that on an operational basis. Same time, some of the issues going around E15 doesn't make that job easier.
No, it doesn't, Jay. And I think Jay's referring to is there's recently a court ruling that kind of unwound an EPA approval to use E15 on a year-round basis, which we were disappointed by. That was frankly one of the things that allowed us to push forward and go spend time and money on our own terminals and working with our two major partners at New Star and Magellan to make it more available. As if a product can't be used year-round, really hard to move the ball on that. And that story's not completely written yet, Jay. A court made a ruling. I think by the time we get to next spring, hopefully there's a more reasonable resolution to that and we can continue to press forward. But to your point, between that and, kind of underground equipment that sometimes need to be replaced, it doesn't mean that we've removed all the barriers, but we've pushed down some pretty significant ones.
Any questions from in the room? Otherwise I'll go to one that came in. Okay, and Olivia, maybe I can ask you to come forward and address one. So the question coming in from online was, considering the use of preferred stock and the majority of the funding for the nitrogen investment and the fact that the preferred stock dividends don't run through the income statement, which is the way it is properly done, what is the true performance of that investment this year and also from inception? So I don't know if you have all those numbers at your fingertips, Olivia, but you probably have a sense for that answer.
Sure. So first of all, I'd say that in our capital structure, we take in the cost of the preferred stock as well as debt in our capital structure to come up with our weighted average cost of capital. And we compare all of our investments against that cost of capital. So we make sure that we are taking into account the cost of the preferred stock as well. When we look at the returns on CFN, we look at that net. So we look at it fully burdened for the cost of the capital and any management time that would be attributed to it and other costs. It was trending, hovering around 2%, above or below 2% the last number of years. This year it's trending to be over double that. So that's what I can tell you on the return. If somebody wants more specifics, I'd be happy to get them if they want to reach out to me.
No more after we close the fiscal year. So we're still.
Yeah, exactly.
Yeah, right. So much better performance, not what we would have hoped for, but I can't change that, but much better performance as we've gone through into this year. Yes.
So you've talked a little bit about carbon, very briefly.
Yeah.
Gary and I were talking about it the other way. And maybe it's a question for Gary on the agronomy side, but it's obviously going to have an effect on the whole industry. How do you guys feel about carbon and the carbon programs that are coming out that will directly affect the farmer, but also affect the farmers?
Yeah, so let me just shoot the question. I think, and I think you've heard enough from me, and I'd like to let Gary have a chance to address it for you. So the question for the people online is just a question around carbon and the impacts on agriculture, maybe the opportunities on agriculture, particularly as it relates to agronomic point of view, and if you and Rick, if you have anything to offer from the field side, we'll give you a chance. But Gary?
Kevin, thanks for the question. Carbon seems to have supplanted a lot of the news from COVID, hadn't it? It reared its ugly head some months ago, and it got to be ag's most popular topic. I think societally, agriculturalists, whether it's the rancher or the farmer, are looked at to provide a lot of the solution set in terms of sequestering carbon dioxide. It's unfortunate that we have very little science that backs this activity. We know that there's a couple of key cultural components in terms of remediating or sequestering carbon. One is no-till, and the other is cover crops. Those are kind of the two most common. Now, third, if you're a rancher, methane gets talked about a lot, and trying to even breed cattle to produce less methane is part of the solution in that industry. For us, it's interesting that the green biomass of a corn plant, we know it's going to consume more carbon dioxide than a soybean plant. It's kind of obvious based on the structure of the plants. And yet, as Jay said in his opening remarks, it doesn't matter. It doesn't get credit. It's what we do from here forward that matters. I think what I would say about the programs, whether they're at $9 or maybe someday $90, we don't know that that's right, and we won't know until we have the science to really back up how we're advancing the carbon sequestration in the soil, Kevin. And that's the work that has to be done. We partnered with a company called Trace Genomics that's advancing some really, I think, interesting disruptive technology to help prove that. And it's those steps that'll ultimately determine the success or failure of a lot of the programs. I would say, though, as my final point, I think all the companies that are offering some kind of a carbon program, one, they're leaders, and leaders are going to stumble in this space because there's more questions than answers. But at least we're taking a step in the right direction, and we really won't know who's right or what steps are right until the USDA finally comes with the final results of the Growing Climate Solutions Act that's now passed the Senate. We won't know what's right on behalf of agriculture until we get kind of the rest of the program from the government's perspective. So a lot of questions yet, but good activity from some companies proving some leadership.
Rick,
yeah, I would just say this is, and Jay mentioned, we spent some time with the board and the SLT just a couple of weeks ago talking about this. And I think one thing we realized is a the words used, and I think they're right, is this is the Wild West. Nobody's got this figured out yet. We had some very smart people, leaders in the industry talking about it. And I think it was pretty clear they don't have it figured out yet. So I think as a company, we know we've got to elevate our attention and be at the table to sort this out. But I'm not sure trying to be a leader without good economic foundation is a wise choice right now. So we've got to be right there watching and respond accordingly.
And that doesn't take anything away from companies that are, you know, leaning a little bit. That's just fine. And we'll all learn a little bit from that. But we are also kind of looking at it from the lens of how does this work across an industry with scale and opportunities for both buyers and sellers around the world, right? Because this isn't a U.S. issue. So that's our approach to date. I think the last question I'm going to take, and yes, John.
And then the last one, I got one. Under operations, there's been 3 business units sold. I think there's another one being sold. What's the long-term strategy with that operation?
Yes, so I'll just take that one. We have 3 business units that we did decide to reposition, and only 3. So one was out east, which we did last year. One's out west, which we are doing currently, and we've got one in Wisconsin that's in play. And as a direction, those are the only 3. So that is an important platform for the company. We intend to invest where we do think we have got opportunities as much as we can across all the business units. And that's not the same everywhere, but as much as we can across all the business units. But we also are going to be very, transparent and aggressive around facilities that we think really don't fit us long-term, which we thought those 3 fall in that category. But in addition, we will always keep our eyes open. If there's assets within an individual location, we're going to be, pretty careful about, does that still fit? So if there still could be opportunities or kind of change across an individual business unit where that's the place. But we are, country operations is an important business unit for this company. It will be an important business unit, but they'll be under the same scrutiny that any of these other people are around assets inside their portfolio. If they're not performing, how are you going to get them to perform? Or if they're best in the hands of somebody else, then let's pursue that. Rick, anything more you'd say?
John, it goes back to my point I made about asset optimization, because quite frankly, those 3 that Jay spoke of, when I look at how it fits the agronomy, energy, global grain and processing supply chain, they were on the outside. And we just looked at it and said, rather than us continually starving those businesses for capital because they don't fit the enterprise, we have other places that are much higher priority to invest because we got a lot of good things that we can do for growth. Those weren't one of them. So we were just honest with ourselves and said those assets are better held somewhere else, and it treats those local farmers in a better way. So we can come back inside the system and invest around our supply chains and make our supply chain stronger. So that was the thought process behind it, John.
I think the last question I'll take, and Dave Johnson, as a member of the Capital Committee, is here to jump in if I go askew. But the question really was, those of us for which age 65 is but a fond memory, which I thought was a nice way to kind of position it, are concerned about the status of the equity, the deferred portion of our patronage account. These are considerable dollars. Please give us an update. So this is part of the equity decisions the board weighs, and frankly, to some of the questions earlier in the day, can arrive at decisions that the board needs to make that sometimes are not popular with others as they could be, as they do recognize the commitment to those people that are age 70 and estates. So that is very much in the mix for the board as they make these decisions. They recognize everything, and sometimes those decisions maybe can be looked at as one particular person as, well, I wish there would have been more for me. Believe me, I get it. I know the board gets it. But we also have the responsibility for the people that are at this point of their life and this point of their career that we also have a responsibility to. So Dave, if anything that you'd add, feel free, but that's what I would say.
I don't know if I can add any more to that, Jay.
Oh, you got to use the mic there, Dave. Can you live this mic, please, Jim? Go ahead. You just should be able to speak.
Is it live?
Yep.
I really don't know if I can add any more to what Jay said. I mean, the one thing that, if I'm understanding the question correctly, is for the local cooperatives, and I think I mentioned it to John too, that we're current up to 2007 now. The part that sometimes is overlooked is for those that are turning 70, they probably have equity far older than that they have not been able to catch up to that 2007. So that's part of it too. I mean, you could have individuals that have equity that's, goodness, how long have they farmed and been a part of this?
Right.
And they've not seen any equity revolved yet. Right. So that's the other piece of that, I think, that sometimes needs to be illuminated.
Remembered. Yeah, we were reminded. Well, I show 12 o'clock. We are respectful for your time. We're respectful for the opportunity that you gave us to talk with you about business at CHS and to hear some of your points, whether they be a good challenge for us or just information. Both are fair game. I'm just, I look at this team with Olivia and some of my team members that are here. I've never felt better about the leadership team from the business and the areas that support the business than I do right now. When Merlin, when we make the comment that we're going to throw both shoulders behind, seeing what we can work to with local cooperatives that aren't easy answers, this is the caliber of people that are going to try to do it. There's nothing more than a straightforward approach of let's see what we can make better here. Doesn't make it easy, doesn't make it simple, but we got shoulders behind it, and I think we have shoulders from some extremely talented people to do so. So I want to thank them, and I'd like to close with thanking you for your support for CHS, for your support of the Board of Directors and the management team of everything that we are able to earn. I couldn't stand in front of you without saying, and we are going to try to earn more. And that's what we're all about, and to grow the company and grow our business with you, and know that it has to be a win-win. I get that, but we are leaning in to do so. So thank you so much for what we are able to do. Thank you for joining us for this morning. We are going to, for those of you that have time to stay for a sandwich, they're going to magically open some little door over here, and the room on the other side of this wall is where we're going to have lunch, and tables are set up. So probably would be best that you brought your stuff with you into the next room to have a sandwich with us if you can. If you can't, thank you for coming. Good to see you all. Welcome to the annual meeting coming up in December. Look forward to seeing you then, if not before. Thank you.